It can be such an incredible feeling when hundreds of thousands of dollars hit your account once your RSUs vest. They're an incredible wealth generating opportunity, and more companies are starting to offer RSUs as compensation to their employees, specifically in the tech industry. But they also come with complexities around financial planning. I'm Matt Bremer, wealth advisor and owner at Queen City Wealth. I work with individuals and families to understand their complex financial structure and make smart decisions as they prepare for retirement. If you find this video helpful, be sure to like and subscribe, and you can reach out about working directly together. When were the shares first rewarded? The first step in your planning process is to document when you were first rewarded the shares, as this leads into the vesting schedule. Companies can offer various different vesting schedule options. For example, they may vest a certain percentage each year, say 25%, vest each year for 4 years, or you may receive them after a periodic time of, say, 1 year, 3 year, or 5 years. If you are able to have your shares vest during rolling periods, this can be helpful in building your financial plan as it allows you to manage the tax. Then the question is, what happens when your shares vest? RSU shares vest as ordinary income, and this means you can pay a higher tax rate during this vesting period. When RSUs vest, the market value is ordinary income, and that will be on your W-2. Typically, companies may withhold taxes when the shares vest and you receive the funds. You should understand how much your company withholds. Companies may withhold too little, causing you to have a large tax bill come April. They may only withhold the federal income tax amount and not account for your own nuanced taxes, such as state and local taxes. When the shares vest, your cost basis becomes the price on the date that the shares vest. It may be advantageous to sell some shares when they vest, but then you are also beholden to the short-term capital gains tax. You have to then hold the shares for 1 year to have the sales taxed at a long-term capital gains. Right now, short-term capital gains are taxed as regular income as part of your normal tax bracket, while long-term capital gains can be taxed at 15 to 20%, depending on various factors, and sometimes even 0%. So there are several factors to consider on when you should sell the shares, and you should consider your goals, market view, and tax plan. If you sell all the shares at once, you would be creating a large tax bill for yourself, but this provides you with the ease of mind that you have received the money and are able to do with it according to your own goals. However, the downside could be that you miss out on more significant gains on the future in the growth of the stock if you sell it. Creating a sell strategy or diversifying through covered calls is important to manage that risk. If you want to wait 10, 15, 20 years, you may also expose yourself to large long-term capital gains, and it may make this decision to sell that more difficult. If you can take the emotion out of selling, then that can bring a lot of ease to yourself. Some other considerations as you start to plan around your RSUs. Does your company have a reliable RSU schedule? Do you understand when your shares vest? Which time periods if you have multiple RSU grants? And how many shares you'll receive at each vesting period? Continuing to hold the shares, this does expose you to risk if the stock goes down. If you are planning to hold the stock for the 1 year for the long-term capital gains benefit, then you have the risk of the stock being lower after 1 year. There are several different strategies that you might consider when receiving your restricted stock units. One is to consider a rolling strategy. Plan out over a period of time to sell an equal amount each year for that period. So, for example, if you receive 500 shares, you may decide to sell 20% or 100 shares each year until you've sold all the shares in that 5-year time period. Or two, you can create your own personalized selling strategy based off your own formula or financial goals. The risk is to manage what your investment exposure is to this single stock. Receiving RSUs is becoming more common as a salary offering, but it does expose you to this single stock risk. It can cause a lot of anxiety if you are seeing large swings in the stock price, which then cause large swings in your individual net worth. RSUs are typically dependent on employment, and if you choose to leave a company, you may be forfeiting those unvested RSU grants. If you leave a company with vested RSUs, then you will get to keep those and owe the taxes on any future gains that you sell. There are also key differences if your company is public or private. If the company is private, there are expectations that it may IPO soon. If so, this may allow your shares to vest sooner at the IPO, but you may be limited in a lockup period. RSUs should also factor into cash flow management, savings, goals, tax planning, and retirement planning. For instance, you could use RSUs for down payments on a big purchase, such as a house or long-term goal like education savings for children. RSUs may be key to your compensation package and they may come with unique tax challenges. You deserve personalized service that is unique to you. I work with professionals to help them manage their vesting schedules, minimize taxes, and build strong financial strategy. Reach out to me at Queen City Wealth and we can discuss more how to create a strong financial asset and build a diversified portfolio to meet your life goals.